So let's continue with the final section of chapter 2, and that is collective investments, sometimes referred to as collective investment schemes, otherwise known as CIS. Another name for them is funds. Collective investments, collective means a group of people invest together. That's what a fund is. Investors pool, bring together their money, their assets, and these monies are managed by an independent fund manager who has a mandate. He has to follow that mandate in order to invest. Sorry, the mandate is usually to invest in the best interest of his investors. And these funds can have certain objectives, either to generate income, to generate capital appreciation, or a combination of both. So, for example, you can see for fixed income funds, like bond funds, they're most likely going for income. Stock funds or equity funds can have a combination of both. Funds that are dedicated to derivatives will be purely capital appreciation. Advantages of collective investment schemes. You don't have time to manage your own portfolio. So you invest in a fund. You've got a professional fund manager who is an experienced investment professional. He is managing your money. You don't have the expertise to create and invest and manage your portfolios. So when you invest in a fund, you are indirectly using the expertise and experience of the fund manager. You benefit from big numbers. So if you're going to buy a certain property yourself, you're going to pay all of the fees by yourself. But if you invest in a fund, the cost of investing in these properties is distributed among all of the thousands of investors. So the bigger the fund, the lower the cost on you. Economies of scale means saving when the fund is growing. And of course, diversification, because you can invest in a fund which has invested in 300 different properties. You can't buy 300 different properties yourself, but when you invest in a fund, it gives you exposure to these different assets. Disadvantages of funds, well, it's not all good news. You still have to pay costs. You have to pay the fund manager, you have to pay the cost of establishing the fund, marketing costs, accounting costs, legal costs. There's usually an initial charge, sometimes called the front end load, which you pay to enter to the fund. And then you have to pay ongoing fund costs. These are usually annual, operational, plus management fees. And then if you decide to leave the fund, you're very likely to pay exit fees or exit charge, which is sometimes referred to as back end load. Risk and returns are not guaranteed. You have no control over the investment. I mean, if the fund is invested in property, you can't tell the fund manager, I don't like property, please change to equities. You can't do that. You have no control over what the fund manager invests in. As an investor, you lose your choice over individual investments. So even if you like stocks and the fund is invested in stocks, but let's say you like Amazon and Tesla, that fund isn't invested in Amazon and Tesla, you lose that choice of choosing the individual investments that you like. Now, collective investment schemes or funds in the UK can be either regulated or unregulated. Generally, all around the world, funds are either regulated or unregulated. Unregulated, we most likely refer to hedge funds. We'll talk a bit about hedge funds at the end of the chapter. Unregulated, U means unregulated collective investment schemes, unregulated funds. Now, the rest of the funds that you know, whatever fund that comes to your mind, is most likely going to be regulated. When we talk about the difference between regulation, difference between bonds which are regulated and unregulated, we basically talk about how much protection and oversight is the regulator given to these funds. Hedge funds aren't heavily regulated, so the regulator doesn't oversee hedge funds much. The regulator doesn't restrict hedge funds much. Regulated funds are overseen and are restricted in certain elements. So let's just look at define what regulated means. When we say regulated, a regulated fund is usually a fund that has to be diversified. Well, let me just make this clear. Must be diversified. So the regulator says, okay, fine, you want to establish a fund and you want to invite the public to invest in it, no problem. Our first requirement is your fund should be diversified. It should not be concentrated in a small number of investment. It should be diversified. The second thing we mean when we say regulated is that there is usually restrictions on controlling interest. Controlling interest means how much interest, how stocks, how many stocks a fund can buy in a certain company. So a fund cannot own more than, let's say, 5% of a certain listed company in the market. You can invest in as many companies as you want, but your ownership, your interest, your ownership in these individual companies should not cross a certain limit. That's what we call restrictions on controlling interest. Because as soon as your ownership crosses a certain limit, you become, as a fund, you become a controlling interest in that company. And usually regulation frowns on that. The third thing we mean when we talk about regulation is restrictions on borrowing. On borrowing / leverage. Usually regulated funds are not allowed to go into debt or much into debt. There is a limit on how much debt or leverage they can have on their balance sheet. Broadly speaking, this is what we mean by regulated funds. Unregulated funds do not have these restrictions. Unregulated funds can do whatever they want when it comes to leverage, when it comes to buying, controlling interest, and when it comes to diversification or concentration. Regulated funds in the UK can either be recognized funds, such as the EU UCITS. UCITS is the EU regulation for funds. So when we say this fund is a UCITS fund, it means it has been approved and authorized, and it is regulated by the European Union. And these are recognized in the UK. They're considered overseas because they are in the EU. And in the UK, you might find authorized fund. These are UK funds in the UK. Now, you will see here, when we move to the right, restrictions fall. So there are less restrictions on hedge funds, and there are more restrictions on regulated funds. Why? Because regulated funds can be marketed and sold to retail investors. That's why the government places so many restrictions on regulated funds. You want to invite the public, the normal guy in the market, you can do advertising to him, you can advertise and attract his capital, but there are certain restrictions you have to meet. Now, hedge funds cannot be marketed or sold to the retail investor. They cannot. So, and usually governments worry much about the retail investors. Since retail investors cannot invest in hedge funds, the regulator doesn't put much restrictions on hedge funds. Hedge funds are usually invest the monies of institutions and wealthy individuals. So unregulated has less restrictions, but no marketing, especially to the retail, whereas regulated has more restriction, but they can be marketed or sold to the public. Let's look at the two categories of fund or collective investment schemes. You've got the open-ended, and on the next page, we don't talk about it. We don't have them here. And on the next page, the investment trust companies are an example of the closed-ended. Let's look at the open-ended funds. What does open-ended mean? Open-ended means the fund manager can create new shares anytime a new investor comes to invest. So if you have a fund managed by a fund manager, and currently, let's say this fund has, let's say, 4 investors, and then somebody, let's say a new investor comes in and she wants to invest in the fund manager will say, welcome. Yes, you are welcome to invest in our fund. The fund manager sells her a share in that fund and she pays for it with cash. This way, that cash is invested in the fund and the capital of the fund grows. The ability of the manager to create and redeem shares, sometimes called units, shares or units anytime there is demand and supply, that ability is what we call open-ended. So open-ended funds have many characteristics. We are going to see these characteristics now. But in the exam, you might be asked, what does open-ended mean? The term open-ended, what does it mean? Does it mean that a portfolio is valued once a day? No. Although open-ended funds are valued once a day, the word open-ended doesn't mean valuation. The word open-ended means the ability of the fund manager to issue new shares or units whenever necessary and redeem them whenever necessary. That is the definition of the word open-ended. So these open-ended funds, they are usually managed by a certain fund manager. In the UK, the most famous open-ended funds are 2 types. You've got unit trusts or open-ended investment companies. These are the 2 most popular open-ended funds in the UK. Unit trusts and open-ended investment companies. We'll look at the difference between them in a bit. You need to memorize their characteristics. A unit trust is managed by a unit trust manager, and an OEIC is managed by an authorized corporate director. They manage these open-ended funds. Now, generally, especially in the UK, the regulator wants to protect the interest of the investors, because remember, these investors are pooling their money into this fund, and many of them can be retail investors, the normal regular public. So in order to protect the interest of the investors, the regulator mandates that there should be a third party. In addition to the manager who is managing the fund and the investor, there should be a third party that oversees the fund. And that third party is usually called a trustee. If it's a trust, we call them a trustee. If that fund is an OIC, open-ended investment companies, we call that third party a depository. That third party oversees the fund, usually protects the assets of the fund. monitors the actions and the investment decisions of the fund manager. Make sure that the fund manager follows the mandate and is acting in the best interest of their investors. Make sure that the fund manager is valuing the units and the shares properly. Of course, if the fund manager is not, or if they're doing anything illegal, it's the overseer that will report them to the regulator. So usually in the UK, these are the three parties when it comes to fund investment. You've got the investor that puts the money in the fund manager that manages that money and invests in stocks and bonds and property, for example. And you've got the third party, the trustee, that oversees the fund to make sure that the fund is being managed properly in the best interest of the investors. Now, of course, every time an investor invests in a fund, the fund manager is going to give him a share. For every, let's say, the price of every share is $10, you give him $10, he gives you a share, you are now an owner in the fund. The shares that the fund manager gives you, they are not transferable. That means this investor cannot sell them to that investor. They are not transferable. Shares in the stock market are easily transferable, but shares of open-ended funds cannot be transferred. There is no secondary market. There is no exchange. They are not traded on the exchange. They are bought and sold with the fund manager. If you want to enter the fund, you give the money to the fund manager. He gives you the shares. If you want to exit, you give him back the share, and he gives you back your money. Trades are performed with the fund manager. Now, the portfolio is valued every day. Why is that important? Because whenever this investor wants to come in and invest, wants to buy new shares or units, the fund manager must be able to give him a price. And what is the price of these shares? The price of these shares is what we call the net asset value of the fund. And it's calculated as follows: the net assets of the fund over the total number of shares or units that the fund currently has outstanding. Of course, the net assets is the total assets minus the total liabilities. So let's say a certain fund has net assets of, let's say, $800 million. And let's say they have 40 million shares currently outstanding. That means issued. This gives you a net asset value of $20. This net asset value is the price of every unit of that fund. This is the case for most open-ended funds. That's how you get the price of every share. So if you want to buy, you want to enter the fund, you have to pay $20 for every share you want to buy. And if you're already an investor and you want to exit, the fund manager will take the share from you and give you $20. This is what we call the valuation of every share or unit of that fund. So the price is based on the net asset value. In this case, $20 is a single price that you are given by the fund manager. Sometimes the fund manager might add $20 plus additional fee. Let's say the fees for transfers and operational costs when it comes to entering and exiting. So you might probably pay 50 cents or $1 extra as an additional fee. But the fund manager will be completely transparent. The fund manager would say the price or the value of every unit is $20, but we are going to charge you an extra 50 cents as an additional fee operation for you to enter or to exit. This is the case for some open-ended funds. For other open-ended funds, if the net asset value is $20, then if you want to enter, the fund manager might sell to you. The fund manager might offer the shares, the units to you at, let's say, $22. And if you want to exit the fund, if you're already in the fund and you want to exit, that means you want to sell your shares, the fund manager will buy them from you at $18. So you've got two prices for that fund. This is called a two-way pricing. And and open-ended funds that have this system are called dual priced funds. So obviously, if he is buying from you at 18 and selling to you at 22, the fund manager is making a profit of $4. This profit or spread goes to the fund manager usually. So you don't know if this $4 is a profit or if it's the fee of entering and exiting. It's not really clear. But everything you need to pay will be in that amount. There will be nothing extra on top of it. So with open-ended funds, there are initial charges to enter the fund. Usually there's also a charge you need to pay for the broker who is introducing you to the fund. So you have to pay the broker, sometimes the bank who is introducing you to the fund, and you have to pay the fund manager also to enter, which we call the front-end load. Remember the front-end load. And then you have to pay annual management charges every year, certain percentage. And then you have to pay exit charges, which we said sometimes they're called back-end load. Now, certain open-ended funds might charge you front-end plus the annual management fees. Some of them might charge you the back-end with the annual, but no front-end. Some of them might charge you the front-end and the annual, but no back-end load. So there are different classes of open-ended fund shares, but this is not a qualification for it. So the same fund that you want to invest in, the same fund, the fund manager might come back to you and say, okay, look, we've got three classes of shares, share A, share B, share C. Share A has front-end load and annual management fees. Front B has back-end load and annual management fees, but no front-end load, and so forth. So they will give you three choices, and you as an investor can choose which one you wish to buy. Front-end load are not listed on the stock exchange. Open-ended funds are not listed on the stock exchange. Also, little or no borrowing. They are rarely allowed to borrow or go into debt or leverage. Rarely. Most of these open-ended funds have little to no debt on their balance sheet. Closed-ended fund, and the most famous type of closed-ended funds are investment trusts. Now, these investment trusts are funds, but they are structured as companies. So some people call them investment trust companies. In the exam, if the examiner is going to ask you about these, the examiner will not mention the word companies, because if he tells you what is an investment trust company, he has basically answered the question for you. So the examiner will most likely ask you, what is an investment trust? Please don't mistake it with unit trust, which we covered in the previous page. An investment trust is different. An investment trust is actually a company. It's a company. It's not a trust. It's traded on the stock exchange. You buy and sell the shares on the stock exchange. And of course, an example of that is REITs, real estate investment trust, which we covered in the property section. These are funds which are listed on the stock exchange, and they give you exposure to property, but you don't buy the property directly, you buy the shares of this fund. Now, they can offer you both ordinary and preference shares, these open-ended funds, both ordinary and preference shares. Also, closed-ended means that the number of shares is fixed. So the fund manager cannot create new shares whenever there is a new investor. If there is a new investor who wants to invest, the new investor must go to the stock market and buy from the existing investors there. The number of shares is fixed. The capital is fixed, usually. Now, I don't want to expand much on, we call this split capital, by the way. If they offer you multiple types of shares, ordinary and preference shares, sometimes we call these investment trusts, we call them split capital investment trusts. So what sort of shares they can offer you? The first type of share they can offer you is a zero dividend share. So just like in the name, these are shares that will earn you no income, no dividend, but they will have sort of a fixed redemption value. That means when this fund shuts down, and usually these closed-ended funds have a maturity period. They have, let's say, they say we are going to operate for 5 or 10 years. So the fund manager would say, at the end of these 5 or 10 years, we will give you, let's say, £2 for every share, but you won't get any dividends throughout your investment with us. Or they can offer you a second choice of shares, and that is income shares, where you get income, dividend distributed to you periodically, and you also get a fixed redemption. So you also know how much you're going to get when the fund shuts down, but that will be usually a smaller amount, let's say £1. And then you've got capital shares. And these capital shares have no income, and there is no fixed redemption. When the fund shuts down, the capital shares get whatever is left. Whatever is left after they pay the zero dividend shares and after they pay the income shares, whatever is left is given to the capital shares, which can be more than £2. It can, depends on the performance of the fund. So these are the different classes of shares that the investment trust can offer to you. Investment trust companies or closed-ended funds generally, they can use gearing. Remember, gearing is another word for leverage, debt. So how do you buy the shares? The prices are dictated by demand and supply, obviously, because they are traded on the stock exchange. And because they are listed and traded on the stock exchange, obviously, the price of the share is going to depend on demand and supply. So if the NAV, the net asset value, if the fund manager is calculating the net asset value of this closed-ended fund, and let's say the net asset value is $20, and you want to go buy it in the stock market, you will rarely find it at $20. You might find it at a higher price, 21, or you might find it at a lower price, 19. So you might find it at a premium, or you might find it at a discount to its NAV. If you're asked what is most likely, discount. Almost 90% of closed-ended listed funds in the UK are traded below their net asset value. So let's look at the third type of funds, and these are exchange-traded funds, or what we call ETFs. Exchange-traded funds are a type of exchange-traded product. It's a product that's traded on the exchange. What are their characteristics? These ETFs are open-ended. That means the fund manager can create and redeem shares whenever needed. So they have the characteristic of an open-ended fund, but they are also traded on the stock exchange. So they have also the characteristic of a closed-ended fund. ETFs or exchange-traded funds have the characteristics of both open-ended and closed-ended funds. They are similar to open-ended funds where the fund manager can create and redeem shares and units. And they are similar to closed-ended funds because they are traded on the stock exchange. ETFs were created in the 90s to track an index. They have very low charges, very, very low charges. They have no entry or exit fees like open-ended funds. Open-ended funds like mutual funds, unit trusts, OICs, they might charge you high fees and they might charge you entry and exit fees. ETFs don't. They are not subject to stamp duty. Stamp duty is a UK tax on financial transactions. So the government relieves, that means they do not charge that tax on ETFs, on trading of ETFs. Why? Because they want to encourage everybody to buy and invest in them. ETF shares can be shorted. That means you can take a short position in them. Only authorized participants can participate in the primary market of ETFs, because whenever a fund, the ETF fund, I don't want to go into the details of the creation of ETFs, but if you got a fund and you got a fund manager, the fund manager doesn't interact directly with the investors in the market. Remember, an ETF is listed on the stock exchange, but the listing does, the units of the ETF do not go directly to the investor. There is a third party here, a market maker, who is called an AP, authorized participant. They take these units from the fund manager, and in return, they issue shares to the public. So this AP, this is the market maker. They are the only ones who are allowed to do this process. So an ETF is a type of product that is traded on the exchange. Other products traded on the exchange are ETCs. ETCs, C stands for commodities, exchange traded commodities. Again, this is sort of a collective investment where you get to get exposure to commodities. And I'm not sure if CISI has included it in this qualification, but you also have ETNs, which are similar to bonds. So they are debt instruments, but they don't pay you any coupon. So ETFs, ETCs, and ETNs are what we call collectively exchange traded products. So this table is incredibly important for the exam. You're very likely to get a question. Most of the questions on these open-ended and closed-ended funds and the difference between them comes from this table. So unit trusts and OICs are open-ended. That means the fund manager can create and redeem shares and units when needed. Investment trusts are closed-ended. That means their capital is fixed and they're listed on the stock market. These characteristics, which we have covered, it's very important for you to memorize them, please. We've already talked about everything. This is just a summary of what we've discussed. Please do not forget to go through these. So main points: a unit trust is a trust, but an investment trust is a company. And of course, unit trusts issue units, but units are just shares. Who supervises them? A trustee supervises the unit trust. A depository supervises the OICs. And an investment trust, since it's a company listed on the stock exchange, they are supervised by auditors. A unit trust, I think CISI has made a mistake here. We don't really call him a fund manager. It's better to call him a trust manager. The fund manager for an OIC is called an ACD, authorized corporate director. For an investment trust, you just call him a fund manager. And don't forget that OICs give you a single pricing for the shares. If the NAV is $20, you pay $20 with a small additional fee. Whereas unit trusts, the trust manager offers you two prices, one to enter and one to exit. And also investment trusts, since they are listed on the stock exchange, usually have buy and sell offers from other traders in the market. Unit trusts and OICs are based, the pricing is based on the NAV. Investment trusts, the pricing is based on market sentiment. That means on demand and supply. So, unregulated collective investment schemes, and we said the most popular type of these are hedge funds. What are hedge funds? The word hedge means protecting your portfolio. If the market is going down, you might lose. But if you have taken other positions, such as shorting of certain investments, you might profit from these short positions. We'll talk about hedging in the last chapter on the last day. So hedge funds were created to protect the investors from volatility and down markets. But these days, hedge funds are they are the opposite of their name. Hedge funds are taking more and more risks. So if you are seeking risk and you're a sophisticated investor, hedge funds might be a good option for you. But hedge funds are not regulated. That means they are allowed to borrow, but they are not allowed to do marketing to the retail investors. And there is no limit on what they can invest in. So hedge funds are not permitted to be marketed to retail investors unless these are wealthy people. Maybe you can market or sell your shares to them. Because they are unregulated, they can invest in any investment they want, and they can take any strategies they want to take. So they can even go short. That means they can sell now and then buy later and take advantage of a drop in the price. Usually open-ended regulated funds cannot do that. However, the fund manager who manages that fund is a regulated person. So you can't have just anybody sitting on the fund and then managing people's money. So even if the fund itself is not regulated, the fund manager should be regulated. And these are usually offshore. Whenever you see offshore in this exam, it's usually to take advantage of tax savings. Risks of hedge funds or unregulated collective investment schemes. They are less liquid because they are not traded on the stock exchange. And if you invest in a hedge fund, the hedge fund manager might put a restriction on you. They would say, you cannot withdraw your money for the next 6 months. They lock you in for a certain period of time. Also, they take large positions. So you might see a hedge fund which has invested like 20% of its money in Facebook. So they are not really diversified. Of course, not all of them, but it's very likely. They take a lot of debt. They are highly leveraged and geared. They are not regulated. They are not protected by any compensation scheme in the UK. So there's always risks of the fund manager defrauding you. They have higher charges. I mean, hedge funds charge their investors the highest fees among all funds. And these investors with hedge funds are usually partners on the fund. They pay big charges because they are promised big returns. Some hedge funds do deliver on these returns, others don't. So they charge you the annual management fee like a normal open-ended fund, plus they charge you a performance fee. They would say, okay, fine, we will charge you 2% management fee every year, and we will take 20% of the profit. That's a performance fee. So if we perform very well, we take 20% of that profit. These performance fees are usually based on high watermarks. What is a watermark? A watermark is basically a previous level of profitability that the fund has arrived at. So if last year they made a 7% return, this year they will only get paid their performance fees if they bring more than 7% return. For example, I'm just giving rough examples here. That's what the watermark is.